So the question is, I think, Brett, and let me rephrase it here. You're asking, when there's a lot of red in net OI, the market can explode lower. When you see lots of green, it can explode higher. So we have lots of red, right? So lots of the red comes from, and stepping back, the net OI column is the net of puts and calls. We negate, we do the algebraic addition here, and we keep track of that minus sign through all of the calculations we do. So we know how much are attributed to puts and how much are attributed to calls. That way, when it's negative, we can color it red, and when it's green, we can color it positive. Or when it's green, it's call centric, and we can color it positive. Also, with the short interest that you see right here, a short put is the same thing as a long call, hence why this is showing up as green. Okay, now to your question. It depends. Whether we explode higher or lower is not based on the color per se. It's based on the overall, what kind of environment are we in? There's another environment we could be in where we're just call dominated up and down. And when you're call dominated up and down, things change for the dealers compared to where we are when we're put dominated. So when we're put dominated, as price drops lower, what tends to happen is that we're capturing more and more, and we've got this heavy concentration of puts that are coming down below us. So we're capturing more and more puts as price drops. Well, as price drops, we're actually adding negative deltas to the complex. We're capturing more of those puts, and turning out of the money puts, which are down here in the left-hand plane, into in the money puts, which are in the right-hand plane as price drops. But we also magnify it by gamma. Gamma relies on price change, and it is the nonlinear addition of either puts, which effectively are red here, the negative deltas due to puts, or it's going to be due to deltas that are attributed to calls. You can see in this distribution right now on the screen, there is no call gamma. I mean, in the net. Of course, there's always call gamma, but in our world, we actually have negative gamma. And before people DM me, we are fully aware that short options are negative gamma and that long options, calls or puts, are positive gamma. We know this. We know this cold. But we do some things with the math to help us identify transitions and all sorts of things. Other people don't do that. We do, and we've been doing it for years, and it helps us understand the environment that we're in. So back to your question, because I think this is really important for everyone. When you are falling in price, and you're doing it through put-controlled strikes, you have negative gamma. I know we think of it as long gamma for puts, etc., everything I just said, but just bear with me. It's negative here because we attribute it to puts, and that means the delta that we're adding to the equation is negative also. So you're now, as price falls, our book, which is the aggregation of deltas, gets shorter. The dealer's book, who are on the other side of the trade, they get longer. All things equal, the dealer must sell, and that accelerates price downward. Now, same conditions, we're down here and we reverse. You unwind, it's still red, you unwind price. So the market dynamics, the volumetrics, the fear and greed that is going on second over second in the market drives price. And as price reverses, we then come back up through those put-dominated strikes. But instead of adding negative deltas, we're removing them, because now we're converting them basically, right? We're as price goes up in a put-dominated environment, we are effectively taking something that was in the money above a minus 50 delta, minus 60, minus 70, minus 80, and we're making it out of the money, minus 40, minus 30, minus 20. That's more positive. Why is that a big deal? With it being positive, we are lessening the negative deltas in our book, which means our book is getting longer. That means the dealer's book is getting shorter. And because price is moving up, effectively rejecting in the money puts, converting them to out of the money. We are rejecting negative deltas, effectively making our book longer. And all things considered, we get those V-shaped reversals off the bottom. So to your question, you can explode upward in a put-dominated environment. In fact, those are V-shaped recoveries. And we actually believe that's the mechanism that we're seeing here. It's all driven by fear and greed, where monetization occurs, etc. So, has nothing to do with the call side of the equation. We're at the green side of the equation. It has everything to do with how far are we stretching the rubber band down, how deep are we getting from where we started, where the speculators actually placed their bets. And they place their bets with out-of-the-money contracts. And when the price is falling, those out-of-the-money contracts are generally puts. When those puts become at the money, a 50 delta, minus 50 delta, of course, because it's a put, then they monetize. When they monetize, you're taking 50 deltas off the table, multiplied by the net OI, multiplied by the gamma that you're taking off the table, and all of a sudden price starts really moving in the other direction. So you get this V-shaped rip-roaring reversal when monetization occurs. And, it looks like we're kind of in that situation. We're up to, 57.33 now. This is that area that I was talking about. We probably could play. I hope many of you listening actually got in at the 25 strike and are now playing this up to 50. That'd be a 25-point wide move, and that would be a great thing to do. So here we go. Brett, let me know if that answers your question.